Michael Burry just bet everything on these 7 stocks. This is his portfolio now. In this video, we'll take a detailed look into Burry's most recent stock portfolio to help get a better sense of how he positioned himself for success and to understand the reasoning and thought process behind his investments. Let's jump right in, and if you're new here, take a second to subscribe to gain access to more investment content like this in the future. So this is Burry's stock portfolio as of the end of September 30th, 2019, and it's a very concentrated portfolio, only investing in 7 stocks. In fact, the vast majority of his portfolio is invested specifically in beaten down retail stocks. His top 7 positions in order of portfolio weighting are Gamestop, Tailored Brands, Alphabet or Google, Sportsman Warehouse Holdings, Bed Bath & Beyond, Canadian Natural Resources Limited, and New Vectra Corporation. We'll be discussing this in much more detail, but I want to provide a little bit of context for how we actually got here to begin with. You see, back in late 2018, we actually saw for the first time a glimpse into Michael Burry's portfolio when he released his first 13F filing to the SEC in over several years. Now, while that portfolio was still concentrated, it was a bit more diverse in holding 16 holdings. And over the last year, only 4 stocks from that original filing still remain in his current portfolio. The next quarter filing was for stocks held at the end of March 2019, and in this case, Burry sold out of 5 of his previous investments, added 3 more, and adjusted the weightings on the remaining investments. The performance of these stocks following March was lackluster, and Burry was actually down about 10% relative to the S&P 500, which is roughly flat around that time. Next quarter, at the end of June, there was even more portfolio turnover, where 8 stocks were completely sold out of, and 4 new positions added to the portfolio. After coming off a rough quarter, the next quarter's performance was roughly similar to the S&P 500, with Burry's portfolio up 2.2% versus 2.9% in the S&P. Now, in between that second quarter filing and the third quarter filing we're looking at now, Burry actually took an activist position with 2 stocks in his portfolio, both of them beaten down retail stocks, the first one being GameStop, and the second one being Tailored Brands. The investment thesis and activist effort for Burry on both of these stocks was based on the argument that they were significantly undervalued compared to their future cash flows, but management had poor capital allocation strategies. Burry argued it would be better off for investors if the management of each of these companies used excess cash to buy back shares in the market while prices were at or near all-time lows due to extreme market pessimism. As we'll see soon, these activist efforts appear to have paid off well for Burry this quarter. Then in September, Burry rings the warning bell about index funds and a potential ETF passive bubble, expressing his concerns about those investments in an interview with Bloomberg, which of course begged the question, given those concerns, how is Michael Burry investing his money? And to that, Burry said he likes small cap value stocks because they tend to be underrepresented in passive funds. Which brings us to today and Burry's current portfolio, which really reflects his fund's investment philosophy, not only as a value fund, but as an opportunistic fund. Since the last quarter, Burry sold out of 7 of his stock positions, concentrating his portfolio into what he believes are his best investment opportunities. So let's first take a look at some visualizations of Burry's portfolio, and then we can go back to the numbers and analyze each of these investments in a little more detail. So the first graph I'd like to take a look at is the portfolio holding changes graph. Now what this graph tells us is the relative proportion as a percentage of the portfolio that each stock was invested in at the time of filing. The red bar represents the percent of the portfolio each stock was in during last filing, and the blue bar represents the percent of portfolio this filing. So these standalone blue bars represent completely new positions in the portfolio. Blue bars above the red shading represent a higher proportion of the portfolio in those stocks during this filing, and the red shading without blue bars are the exited positions. So from this we can see that Burry is running a very concentrated value stock portfolio. At the time of filing at the end of September, GameStop was roughly 28% of his portfolio as his largest position. His second largest position, Tailored Brands, was about 21%. So combined, those top 2 positions make up nearly 50% of the entire portfolio. The next 3, Alphabet, Sportsman Warehouse Holdings, and Bed Bath & Beyond, each make up between 13 and 16%. So in total, if you look at the top 5 positions, they make up roughly 93% of the entire portfolio. Burry's position in Canadian Natural Resources and his much smaller bet in New Vectra Corporation are relatively a much smaller piece of his portfolio. Now, one thing I should note about these stocks listed in the 13F filing, and the reason why there's an asterisk here, is because the stocks listed in the latest filing likely only represent about 18% of the total assets under management at Scion. This is based on the September 4th Bloomberg article, where Burry was stated to oversee about $340 million. If you look at the value of the stock holdings at time of filing, it was roughly $60 million, which means that Burry has roughly $280 million invested in other assets beyond stocks. But focusing back on the stock investments that we do know about, Burry's not only concentrated in a small number of stocks, but in a very specific sector. In this case, over 76% of his portfolio is invested in stocks in the consumer discretionary sector. And in fact, all of these are specialty retailers. Gamestop is a specialty retailer that specializes in selling video games and related hardware. Tailored Brands specializes in selling men's suits. Sportsman Warehouse Holdings sells outdoor camping and sports equipment. And Bed Bath & Beyond is a specialized home furnishing store. This pie chart just gives another visual example of the degree of concentration in the portfolio. Now, one thing to keep in mind with concentrated portfolios is that when you have a large percentage of your portfolio invested in an individual stock, the overall price of your portfolio tends to be more volatile in the short term. With a concentrated portfolio, you can see very large swings either up or down in the value of your portfolio even day to day. We saw an example of this volatility as a result of portfolio concentration in Burry's portfolio following his Q1 filing. While Burry's portfolio was down about 10% that quarter, he more than made up for it this quarter. In this portfolio holdings performance graph, the blue shading represents the value of each position at the time of filing, and the red bar represents the value of the position at the time of this recording. It's been just 45 days later since filing, and already all of Burry's top 5 portfolios have shown very meaningful stock price appreciation. To get a better sense of this breakdown, we can take a look at the portfolio return by holding over this 45-day period to see how much each stock contributed to the total return in the portfolio over this time period. So from this, we can calculate that Michael Burry's stock portfolio in total is up about 17% over just the last 45 days. This is an incredible return, and it's part of the reason why deep value or contrarian investing is a very difficult thing to do, because you have to have the conviction to hold on to your positions even in a quarter where you're underperforming the market by over 10%. What's even more incredible, and you can't fully tell from this graph, is that the true portfolio gain that Burry achieved from GameStop is likely significantly understated in this graph. You see, this only counts portfolio return since the day of filing, which was September 30th to now. And although GameStop was up 6.5% in this period, the majority of that gain actually came earlier. Remember, Burry wrote his letter to GameStop August 16th, and on August 19th, he reported that he owned 3 million shares or 3.3% of GameStop. You'll see that Burry's letter effectively marked the bottom for the stock at a price of $3.32. Since he released that letter, GameStop stock is up over 70%. Now, while Burry had owned GameStop shares in the past, he sold out his position as of the filing before this one, likely so he could begin accumulating an even larger position at a lower cost basis, then pursue activist efforts with the company in an effort to try and improve capital allocation and investor returns. So far, it looks like he's been very successful in achieving that with GameStop. So to get a comparison, Burry's stock portfolio holdings are up 17% over the last 45 days. This is compared to about 4% in the S&P 500 over the same period in time, and a little over a 10% return in my individual stock holdings over the same period in time. One thing to note is that over this period, it seems that value stocks, and especially deep value stocks, have relatively outperformed the broader market. Now keep in mind this is over a very short period in time. 45 days is not long by any means, but it'll be interesting to see if this trend continues in the future. What's interesting about value investing is that over the short term, it doesn't always outperform the market, and you may be down year to year compared to the S&P 500. However, over the long term, value investing tends to provide better risk-adjusted returns, achieving higher returns with the same risk, or the same returns with lower risk. Either way, this will be a fascinating dynamic to watch over the long term. So next, we can provide a bit of commentary on each of Burry's individual positions, and then take a look at a more in-depth valuation model for one of his stocks. So we've discussed GameStop a lot, especially with Burry, but I think the main investment thesis is relatively clear at this point. Burry believes that with the upcoming new console cycle, GameStop's core business won't decline as fast as the market thinks it does. Unfortunately, another thing that was driving market pessimism with GameStop was investors' lack of trust with management. Management was well compensated for leaving a significant trail of shareholder value destruction, which is part of the reason why that management was completely removed and replaced in 2019. Going forward, Burry and other stockholders would like to see more shareholder-friendly capital allocation, giving cash back to shareholders in the form of buybacks while share prices are relatively low, and it's an efficient use of capital. Tailored Brands shares a similar investment thesis to GameStop. The stock is trading extremely cheaply, but the business is facing declining earnings, and investors are not confident with management. In addition to that, Tailored Brands has a very high debt level, so it's likely that before Tailored Brands is able to deploy a significant amount of cash for buybacks, they're going to have to focus first on paying down debt. Investor concern over elevated debt levels is one reason why I think the stock price has been relatively stagnant, even over this period where we've seen significant appreciation from many value stocks. Alphabet's stock price recently hit an all-time high, and if you want a more in-depth analysis on the company and the stock, you can take a look at a previous video I did specifically devoted to analyzing Alphabet stock. It'll be the third link in the description below. Sportsman Warehouse Holdings and Bed Bath & Beyond, again, are both specialty retailers whose stocks took quite a beating through August. This left them trading very cheaply relative to cash flow from extreme market pessimism due to investor concerns over many specialty retailers at that time. Canadian Natural Resources is a company I'm not too familiar with, but they are an independent oil and gas producer. They have a market cap of roughly $33 billion, pay a dividend of about 4%, and are trading below market valuations relative to earnings and free cash flow. This represents about 6% of Burry's portfolio, and he likely knows something that we don't, so it'll be interesting to see where this position lands in his portfolio in future updates. Vectra Corporation is a medical device company. This is a very small position in Burry's portfolio and makes up less than 1%. The company recently filed for Chapter 11 bankruptcy, so my view is Burry likely viewed this bet as having binary options. Probably the most likely outcome is bankruptcy with negligible value to shareholders, but on the chance they do stay solvent, there could be significant upside for the remaining shareholders. In this case, it looked like it didn't work out, but it has negligible effect on Burry's portfolio. So finally, we'll be taking a look at a more in-depth valuation model for one of Burry's stocks. In this case, I'll be using the valuation calculator in my spreadsheet library, and if you want to download a copy for yourself, you can check the second link in the description below. In fact, specifically just for this video, I added a lot of new features to help visualize some specific concepts. So what you're seeing now, version 3, won't be available for a few more weeks as I finalize things, but you'll still have full access to the main model, and I'll provide an update when this one's fully released. So I know this looks like a lot, but it's actually not too bad. We'll break it down into the main 3 sections. The first section is inputs. The next section is the outputs, what we actually generate from our assumptions. And then the rest are the visualizations for understanding the valuation. So in this case, we're looking at a valuation for Gamestop, in this case in 3 scenarios: a favorable scenario, a base case scenario, then also an unfavorable scenario. The way I'm modeling it, the only difference in these 3 scenarios is in their expected earnings growth rate and their ending expected price to earnings multiple. In the unfavorable case, we're assuming a lower multiple, and in the favorable case, we're assuming a higher multiple. Since this is a 2-stage model, for the first 2 years, we're going to assume that GameStop is actually able to increase earnings through 1, the release of the new console cycle, and 2, better cost management, which they've stated is one of their goals. After those 2 years, we'll assume GameStop resumes a secular decline in earnings from years 3 onward. And in the case of the unfavorable situation, there's actually no increase in earnings from the new console cycle, and earnings are expected to decline 15% annually starting in year 3. So with this, we can model the expected price we'd need to pay for the stock today in order to achieve a roughly 12% rate of return. So in the base case model, we would need to buy at $6.15, and since GameStop no longer pays a dividend, we would get 100% of that return from the sale of stock in 5 years at roughly $10.80, which is equivalent to our projected $1.36 of earnings per share times an assumed 8% price to earnings multiple. Now, if you believe those assumptions to be true, then a current stock price below that would be a margin of safety, likely indicating the possibility of higher upside potential if these assumptions play out, or potentially lower downside risk if they don't. So I don't know the exact assumptions that Burry was using in his modeling, but if he had something similar to this as a base case, then when he was buying the stock roughly between $3.50 and $4.50 during his heavy accumulation period, then he was buying at a very healthy margin of safety to his base case scenario. So in his view, it was very likely that he was going to see rates of return well in excess of 12% per year. And in reality, he did achieve that, because over the next 3 months, he saw returns of roughly 40 to 50%. Now, while it's much less likely that we see assumptions hold true similar to the favorable scenario, if that were to occur and we see earnings roughly double over the next 2 years and then fall off at a more gradual rate of decline, then GameStop is still significantly undervalued today with a high margin of safety. However, when modeling, I usually don't spend too much time on the favorable cases because I'm more concerned about the unfavorable cases. It's those unfavorable cases that give you a better idea of what the true downside risk is for the stock. So in an unfavorable scenario, the fair valuation for a 12% return is roughly $2.30. So that doesn't look too great considering the current price is more than double that. However, if we change our expected rate of return from 12% to 0%, we get a price of $4.05. So what this price means at a 0% required rate of return is that if all these assumptions hold true, If we buy at or below $4.05, we won't lose money. So another way to think of this is that with the current price of $5.66, you'll lose about $1.60 if the unfavorable scenario plays out. So Burry might have seen a similar limited downside risk when he bought into Gamestop so heavily. It may have been part of the reason why it's his largest position in his portfolio today. Now I want to take a look back at the base case scenario just to explain these visualizations. The graph in the upper left is the expected share price and value of reinvested dividends at the end of each year. Below that is the expected earnings per share and dividends for each year. What I find are the more interesting graphs are actually the return component amount and also return component distribution. So for the return component amount, this assumes you invest $10,000 and the assumptions in the model play out. This shows you how much of your return really comes from increases in the growth of earnings versus that of increases in valuation, and also compares that to the dividends that you receive over time. So based on the model, early on, the majority of the value of the increase in the stock comes from an increase in earnings. But then as you go over to year 5, as the earnings decrease, the majority of the value instead comes from valuation or multiple expansion, meaning investors are willing to pay more for the same dollar of earnings. This means that for your investment thesis to hold, you're relying on about 4% of your returns to come from increases in earnings, and about 95% of that to come from increases in valuation. So this return component distribution chart can give you a sense of, within an investment, where you're really relying on your returns from. In the case of being so heavily weighted towards valuation, there needs to be some kind of catalyst cause the market to re-rate this stock and have investors trade it at a higher price to earnings multiple. Some examples of this could include aggressive buybacks or renewed interest from private equity. Having only a small portion of your returns come from earnings means that your investment thesis is not as heavily dependent on earnings growth, but as we can see from the valuation, more dependent on changes in investor sentiment. There's so much we can do with this model and these visualizations, and I think it'll be a really useful tool in the future. So I hope you enjoyed the little preview, and I hope to have this up to the group in about a week or two. I hope you enjoyed this video. I always find these portfolio reviews interesting, and Michael Burry has one of the most concentrated portfolios I've seen, which makes it easy to track, but also very interesting. Let me know what you think about Michael Burry's portfolio in the comment section below. And until next time, thank you so much for watching. My name's Michael, and I will see you in the next video.